I think we can, as soon, maybe a minute, and then as soon as you're ready, once you start going, I'll take down the slide. Okay.
We are waiting a little bit while we let people come in.
You tell me when to share, huh?
Yes, we will.
Okay. Welcome everybody to this presentation of the 26th Geneva report on the art and science of patience, relative prices of inflation. I'm Ugo Panizza. I'm the So this report is jointly produced by the International Center for Monetary and Banking Studies in Geneva and CEPR. So I'm here with two hats, the hat of director of ICMB and as vice president of CEPR. And unfortunately, the hat that I don't have is that of Martin Sandbu, that was supposed to be here moderating this discussion, but unfortunately cannot be here with us today, so I'm stepping in. So what ICMB does and has been doing for more than 25 years in cooperation with CEPR is to publish every year a report on a pressing topic in international monetary economics. And what we do, we find an excellent team of authors and we give them a theme and let them write what they think about this theme. And so I think this year we're double lucky. Number one, to have an excellent set of authors. So this year report was written by Veronica Guerrieri from Chicago Boot, Michela Markussen from Societe Generale, Lucrezia Reiklin from LBS, Silvana Tenreiro from LSE. And the topic, I think it's really important, we're all discussing about this, is on inflation. So what we're gonna do, today we have Lucrezia and Veronica. They will be presenting the report, starting with Lucrezia. They will be presenting for about 25-30 minutes, and then we'll open the floor for questions. So if you have questions, please use the Q&A button in Zoom, and then I will relate the question to the authors. So with this introduction done, I'll give the floor to Lucrezia.
Thank you, Ugo. I hope you can see my slides. You can? Great.
Yeah.
Okay, so let me introduce the report. When inflation started climbing up at the end of 2021, two views were expressed by the policy and academic community. The first view was that this was a temporary supply shock, and so the monetary policy had to look through, so do nothing. The second view was that actually that inflation was mostly driven by demand pressures and generating persistent via the labor market transmission process or via wages. And, the danger of waging catching up with inflation and the inflation expectation disanchoring was actually suggesting that monetary policy had to respond aggressively. Now, the common wisdom after some hesitation is that the second view was actually right. And indeed, core inflation revealed to be more persistent than many had anticipated. And a sort of penitence followed, so massive tightening followed from this new view. And we have seen interest rate increase since, mid-2022 in the euro area, a bit earlier in the US. So our report takes a third view. We actually try to look at both from the lenses of an econometric model and also from a simple stylized analytical model, what happens when temporary supply uneven shocks hit the economy. And we show that these actually generate lag response of core inflation and persistence response Especially prices are rigid. And then, eventually the transmission fades away. But the main transmission mechanism is not through the labor market, but it is actually through the good market. And in this context, aggressive monetary policy may actually be damaging. And this analysis is especially important for the euro area situation, where the role of demand was weaker than in the US, and the prices are more rigid than in the US, and where also the energy shock affected demand negatively via the terms of trade, the negative terms of trade effect. So with this introduction, let me just now show you some data, and first on the inflation process and then on the disinflation process, to prepare ground to our analysis. There are 4 key facts that I want to stress. The first is that the supply shock was big in historical, circumstance, in historical, comparison. And it was actually it involved a large change in relative prices. And then I will show what happened to the terms of trade in the US and the euro area, and the effects that this had on consumption investment in the 2 jurisdictions. So that's the first chart that just show that in an historical perspective, since the late 50s, oil prices, gas prices, you see it, they're only available at the end of the sample, they're in red, against the euro area inflation and the US inflation. This, the recent episode is zoomed on the right quadrant, just to show that if you just measure from trough to peak, this actually was a larger shock than what we have experienced in the late 70s and early 80s. Also, the gas stories and the oil story was not the old stories. We also had other supply stress. So this is a global supply chain pressure index, which is computed by the Federal Reserve of New York. You can see the massive increase and then the decrease. Okay, exactly what happened to energy, first up and then down. And this is the second feature. This is a chart that shows the standard deviations of sectoral prices, both for CPI components and PPI component. Again, on the right quadrant, you have it zoomed for the recent episodes. You see that the increase in inflation was also accompanied by an increase in the standard deviation. So so that this is a proxy for relative price changes. Finally, the terms of trade, you see in yellow the US, favorable terms of trade shock, and then for the euro area, this was actually negative, which of course means that the real disposable income of the European citizens was actually hit negatively. And the consequence of that, you can see it in the difference behavior in consumption, investment, and GDP. Here, let me show you consumption. This is equal to 100 in the 4th quarter of 2019. In the dashed line just show the pre-COVID trend. You see that in the euro area we are way below that trend, not so in the US. The picture is even more dramatic on investment, where you see, big difference actually between the euro area and the US. And this, of course, has an effect also on GDP, where you see a gap between the 2 jurisdictions. Okay, so this is where we come from with inflation. Then massive monetary tightening followed, and then disinflation also followed. Okay, so these are the policy rates. I mean, I'll skip this chart. Everybody knows that policy rates started increasing in 2022. And this is actually inflation. We have here headline for the US and for the euro area, and we have core. You see that inflation fell quite rapidly in both jurisdictions, with a little bit of a lag in the euro area, while core inflation remained more persistent, and again, with a lag, more persistent in the euro area, and with quite a long lag in the euro area with respect to the US. And it's actually core inflation, which is really what keeps central bankers, awake at night, and this is, the focus of the monetary policy tightening effort. Now, to put things in historical context again, we can see that the disinflation that we are experiencing, which are in gray for the US and for the euro area, has been much more rapid than two other, kind of benchmarks, which are the disinflation of the mid-70s and the disinflation of the late 70s, early 80s. So inflation is going down much more rapidly than in those two historical episodes. Again, if you look at historical data, for the US, here you have the federal funds rate and the inflation rate for the US. It is easy to see that, the Volcker disinflation in the early 80s, which is really the textbook benchmark for disinflation and the arts of monetary policy, you see that inflation did go down, but, it stays between 3.5 and 4% until the late 90s. So we haven't seen the same kind of, dramatic decline that we are seeing today. Now, two features of these inflation episodes. The first feature is actually that expectations have been, have remained quite anchored. Okay, so that here you have is different indicators of expectation for the US at 5-year horizons. And they've been, they have remained anchored, which was not the feature of expectations in the episode that I cited before, the late 70s, early 80s. And another feature is actually that I'm not showing the chart here, but is well documented in the literature, is that labor market has remained quite tight, especially in the US. But we haven't seen a wage price spiral. Okay, this is documented analytically by a recent paper by Bernanke and Blanchard. But also, if you look at the ECB projections, you can see that, a wage pickup is not actually expected, although there is, of course, some attention there. But, so far, we have not seen a catch-up of wage, notwithstanding the tight labor market, which is considered to be a puzzle, okay? So inflation is, so these are the, I think, key features of these present episodes. And these are very important to try to identify what are the main mechanisms that are going on, okay, that explain, the surge of inflation, but also now the disinflation characteristics. So it is unlikely that the transmission mechanism is via the labor market because of what I cited. But then why is inflation going down so fast, even if labor market is hot? Okay, that's the puzzle. So what we really need to explain is that inflation is going down fast with some persistent of core inflation. And, at the same time, we know, labor market, wage catch-up and the anchoring. So let's make sense of this fact, okay? So I will start with some econometric evidence, and here I will propose few exercises, okay? So before I describe, this messy picture, what we are going to do, we are going to estimate several VARs on quite a rich data set with sectoral inflation. So details on the behavior of sectoral inflation, as well as aggregate inflation, interest rates, and of course real variables. In the first exercise, we are doing the US, for which we have a longer data. So this, you can see, this is the response to an oil shock. Okay, so this chart reports the response to a negative oil supply shock, which increases the WTI price by $1, and the shaded areas are 68, 80, and 90% coverage ratios. You can see here what I want to highlight here is so we run this and the shock here. These are monthly data. The shock, the oil shock, is identified through external instrument using OPEC announcement, as in the paper by Diego Dancing, the recent paper, recent published paper, and we compare this set of results with a monetary VR, which is also where the monetary shock is identified also via external instrument using FOMC announcement. And here you see the response actually to a negative monetary policy shock, which increases the federal fund rate by 1%. Now, if you look with a little bit more time, we could go through all these sectoral responses, but if you look at the responses, what actually, I can summarize it in this messy chart here, where I collapse the responses to the oil shock in yellow and the responses to the monetary shocks in purple. And the feature I want to highlight is that there is much more heterogeneity in the response to oil than in the response to monetary policy shock. Okay, so that's the first result. Now, the second exercise is actually a comparison instead between the US and the Euro area. And here we are running a VR on a shorter sample because of data availability. And we analyze the oil supply effect on sectoral inflation and aggregate inflation for the two jurisdictions. Now here I'm highlighting the result for the Euro area. So where you see that to the initial oil supply shock, inflation rate responds with a lag and features quite a lot of persistence, but core inflation is lagging the response of the headline and is even more persistent. Now, if you compare the Euro area with the US, you can see that in the Euro area, the response of core is much more persistent and is also lag the response of the US. Okay, so this is what the analysis on historical data are telling us. And, in this chart, you have all the details. So, basically, if I have to, if I had takeaways of these results, is that the monetary shock generates less heterogeneity, and the oil shock generates a lot of persistence in core inflation, even if the shock fades away. But persistence, so the shock survives. And the persistence is much more pronounced in the Euro area than in the United States. So at this point, I will then give the floor to Veronica, that will try to catch up this stylized fact through a model and bring some light on what this means. And I'm now stop sharing. Veronica, the floor is yours.
Thank you. Thanks, Lucrezia. Let me share screen. Oops. Okay, can you see my screen?
Yeah.
Yep. Perfect. So, so let me first just sum up all the main facts that Lucrezia has just shown. So she just showed this VAR analysis, and the two main, as she just mentioned, the two main takeaway we want to get from that is first that oil price shocks generates a lot of heterogeneity in sectoral inflation, and in particular more heterogeneity than aggregate demand shock, like a monetary policy shock. And second, that the European response to an oil price shock is shown to be more delayed and more persistent relatively to the US one. And then going a little backward in Lucrezia analysis, from the descriptive evidence that she has shown a lot of things, but two important features that of the data that emphasize other differences between the US and the Euro area are, one, that the terms of trade dynamics are quite different, in fact are opposite. The terms of trade have been deteriorating in Europe, and at the same time they've been improving in the US. And second, Europe, the demand, the private demand, both consumption and investment in Europe has been much more slow to recover relatively to the US. So we need a model to think about these facts, try to rationalize them, and try to understand what are the implications for policy that we may draw from them. We need a model, of course, with multiple sectors, be able to talk about sectoral inflation, with oil, which we think is we have shown that is an important shock to the economy in this period. And we need also an open economy to be able to talk about the terms of trade. So the focus of our model is our story, as Lucrezia mentioned, is that we have a temporary uneven supply shock. And in particular, we are going to focus on oil shock because that's an easy shock to identify. We have shown you some Vieira analysis based on that on the data, and we have shown that it's an important shock in this time period. However, there are other uneven supply shock at the same time that may play an important role, other commodity price shocks, supply chain disruptions following the COVID-19 episode, and so forth. And the model is able to think more broadly about what is the effect of an uneven supply shock. But for concreteness, we'll focus on oil. So I'll talk about oil. So what happened? What's the main mechanism that we want to focus on? When a supply shock or oil shock hits different sectors with different intensity, what happens is that in a model where we have an asymmetric input-output structure, is that we may experience large waves of sectoral inflation that make the response of aggregate inflation persistent. And the key transmission mechanism here is based on two important element of the model. One is the input-output structure, as I mentioned, and the other is that there is price stickiness in the sectors. So the model that we propose is builds on my previous work with Guido Lorenzoni, Ludwig Straub, and Ivan Werning, and is related to work by Aoki, Woodford, and Rubbo. We're going to keep the model simple and stylized just to highlight the mechanism. So there are two sectors, A and B, and we can think about the sector A as services and sector B as manufacturing. So the important thing is that one sector, the manufacturing sector, uses oil directly, so it produces using labor and oil, while sector A, services, uses a combination of labor and goods produced by sector B, so use manufacturing goods as intermediate goods, but doesn't use oil directly. So the production in sector A is just consumed, services are just consumed by households, manufacturing goods are in part consumed by households, in part are used as intermediate goods to produce services. Labor is fully mobile across sectors, and in a baseline model, we keep nominal wages flexible, though we consider also some variant with sticky wages. But our emphasis is going to be on price stickiness. So we assume that firms in both sectors set prices a la calvo, so only a fraction of them each period can set optimally, re-optimize the prices. So let me start from a closed economy. So we are going to assume that the economy has a fixed supply of oil that is used for production, and then I'm going to extend this to an open economy in a little bit. So what's the main equation of the model? The main equation of the model is the sectoral Phillips curve. So the important thing here is that in this model, inflation depends on past inflation because of some inertia, on future inflation because of forward-looking expectations, but importantly depends on the difference between the marginal cost in the sector and the price in the sector. And the marginal cost in sector A in services depends on wages and on the price of sector B production. And the marginal cost in manufacturing depends on wages and the price of oil. So when an oil shock hits, it's going to hit directly the marginal cost in manufacturing, and so inflation in manufacturing. While it's going to take some time for inflation in services to be hit, because there is going to be some stickiness in the price adjustment, and this is going to happen only through the second channel of the fact that the prices in sector B are going to change. So of course, the persistence of the mechanism depends a lot on this lambda parameter, which is the degree of price stickiness in the sector. So let me show you what happened in the model in response to an oil price shock. In particular, actually, in this model, there is a closed economy. This is a contraction in the domestic supply of oil that generates an increase in the oil price. And we are gonna keep the employment constant. So in the background, we have a central bank that keep employment constant. While in the flexible price counterpart of the model, employment would go down. So what is the main graph, the main takeaway from this exercise and the success of the model is the middle panel on the left side that shows sectoral inflation. So this model, stylized, is able to replicate the one of the main findings in the data, which is that there is a lot of sectoral heterogeneity of inflation in response to an oil shock. And you can see that because the red line is sector B, is the inflation in manufacturing that is hit directly, so that jump up directly right away at the moment in which oil price go up, exactly because oil is used directly in the sector. But sectors like services, which here is the blue line, instead do not respond right away, but it takes some time for inflation there to build up, because the build up comes from the fact that prices in sector B are going up, and then slowly this means the marginal costs in sector A are increasing as firms start re-optimizing prices. This is going to build up and create a second wave of inflation. And as a result, for aggregate inflation, which is the yellow line, we see some persistence relatively to the pattern of the energy price shock. So this is the main finding of the model. This input-output structure plus the price stickiness generates this persistence in aggregate inflation. And of course, once we think about the importance of the price stickiness, we can compare two scenarios, one of an economy where prices are less sticky and one of an economy where prices are more sticky. And this helps us reconcile some of the differences between the euro area and the US, because there is evidence that shows that the prices are more sticky in the euro area in the US. And if we compare these two scenarios, we can see from the middle panel on the left, that once prices are more sticky, not only inflation, aggregate inflation goes up less on impact, but it's more persistent, which is what we found in the data, in the VAR analysis. Now, the model is also able to replicate the difference in heterogeneity sectoral inflation in response to different type of shocks. So here we compare the same oil shock that I've just analyzed with the response of the economy to a monetary policy shock. So in this case, to an increase in consumption. And what we see that generates the same, that generates the same increase of sectoral inflation on impact. So that's how we make the shocks comparable. And as you can see, the aggregate inflation behave similarly, but there is a lot of difference between among the behavior of different sectors inflation. So in response to a monetary policy shock, there is much less heterogeneity. There is a little bit of heterogeneity still. Still, sector B, manufacturing, responds more quickly than sector A, because in response to the monetary policy shock, oil prices are also going to endogenously respond. And in fact, we can see that energy prices go up a little bit. But everything is in smaller scale relatively to the situation where the oil shock is the main shock that generates the increase in inflation. So again, this is consistent with the VAR analysis that Lucrezia has shown. Now, what do we draw? What are the implications in terms of policy? So we think it's useful to compare now two scenarios. One, the one on the left, this we label loose monetary policy, is a scenario that I've described so far, where the central bank in the background keep employment constant. Okay, this is it doesn't mean that its interest rates actually are going down. Interest rates are going up here because you can see that consumption goes down less than the flexible price counterpart, but doesn't go up much. So it's relatively loose monetary policy. While we compare this to a tight monetary policy scenario, where instead the central bank wants to replicate the pattern of employment in the flexible price economy. So what's the difference between these two scenarios? Well, there is a trade-off, of course. When we have a tight monetary policy, inflation, aggregate inflation is able to go down to zero. In fact, here we have almost a divine coincidence applying because inflation is roughly zero and we are at full employment by construction. However, if you look at the middle right panel, which is the relative price of sector B of manufacturing goods relatively to services, you can see the relative price in the model, the blue line, move quite less than the flexible price counterpart. While in the loose monetary policy scenario, the size of the movement, although with a little lag, is more similar. So what does it mean for the economy? It means that actually relative in the flexible price scenario, relative price needs to move to reallocate resources efficiently in response to this change in the price of energy. But in fact, this cannot happen in this case if we force inflation to zero and the relative price movement cannot change much. And this implies a welfare loss for the economy. So the fact that relative price movement do not move enough generates a welfare loss that is quite sizable, almost 1 percentage point, relatively to the flexible price counterpart. Okay, finally, I want to extend the model to the open economy version to think about more differences between the US and Europe. So we have seen that the euro area is a net importer of energy prices of energy, while the US has been a slightly exporter, if anything, but we can approximate to the US to a closed economy, while when we think about the euro area, it makes sense to think about it as a small open economy that has not only some domestic supply of oil, but that can import oil from abroad at some international price. So we now consider a small open economy where the shock is going to be an increase in the international price of oil, and we are going to choose the size of a shock so that the energy price move in the same way as the one generated by the decrease in domestic supply of oil in the closed economy. So the two shocks are comparable. And when we look at the difference between the closed and the open economy in the response to the shock, well, in terms of inflation and sectoral inflation, they behave quite similarly. But the big difference that I want to highlight is instead the pattern of consumption, the bottom left panel. You can notice that in the open economy, consumption dropped much more relatively to the closed economy counterpart. And this is because when the economy import oil and the oil price goes up, it's like a negative income shock for the economy. While for the closed economy, the increase in oil is going to go back into the pockets of some households in the economy. So this again, allows us to think about the different response and why the euro area is slower to recover in terms of private consumption and investment, exactly because of these terms of trade differences relatively to the US. Okay, so let me conclude. Lucrezia has mentioned recent work by Bernac and Blanchard, who showed that the recent inflation episode has been mostly driven by goods market and not labor markets. And we have shown how this propagation of uneven supply shock in the goods market generates persistence in inflation through the lens of the model I've just proposed. So in a sense, we think that this evidence, the rapid disinflation, even though there is a tight labor market, the importance of the oil price shocks and in general commodity shocks in the economy and other supply shocks, all these stylized facts support our view that at the origin of the increase in inflation, we have seen this asymmetric supply temporary shock. And so now inflation is going down because these shocks are going to unwind and the effect on inflation is going to decrease. So our study also explains the differences between the euro area and the US. And so as a conclusion, we think that we have three main arguments here for caution in terms of monetary policy. First of all, because we think that the inflation is driven mainly by this uneven supply shock, it is important that relative price adjusts to have an efficient economy. And because this is important, when the monetary authority needs to allow for some more inflation. So more inflation is just a symptom of relative price changes that are actually beneficial for the correct allocation of resources. So some more inflation may be accepted in the short run, knowing that this is just a temporary effect of the shock. Second, we may have not seen yet the full effects in terms of recessionary and financial tightening effects of the monetary tightening that we have seen so far. So we want to be cautious in not overdoing this and having too much adverse effect for the economy that are going to be more generate more persistency if we think that the shock is temporary. And third, why we should worry so much about inflation? Well, the worry is that there is the anchoring of inflation, but we have shown you evidence that there are not many signs of the anchoring of inflation so far. So it's true that there is some endogeneity and monetary policy has been tight, but these graphs do not show sign of worrisomeness. So I think we should keep an eye on them, but we shouldn't worry too much about that at the moment. And this words of caution needs to be even stronger for the euro area, where there has been much less support for demand from the fiscal policy side relatively to the US. Thank you so much. I give the word back to Ugo.
Thank you very much, Lucrezia and Veronica. This was a great presentation. Let me just say that the report is available on CEPR's website. You can download it, and there is also on VoxEU a summary of the report. We can open for questions. We already have some questions in the Q&A, but please use the Q&A button of Zoom to send your question. So we have two questions in. One is purely technical, so maybe let's ask it quickly. I assume Lucrezia will take this one, which is about the identification of the monetary policy shock. I think you have seen it on the Q&A, right, Lucrezia?
Yes, I mean, yes, it is a good question. The shock is the FOMC used as an instrument, but we clean it exactly to take in consideration expectation of future conjunctural development. So we run a regression on the Green Book forecast. This is the reason actually why our sample, when we do monetary policy shocks, finishes in 2015, because that the Green Book are only available up to that date, and so it's the cleanest shock you can possibly have. Okay.
Okay, so then there is another question which has to do with Europe. And maybe let me frame it in a more general question, which also touches on what Veronica was talking at the end. So the specific question that we have in the Q&A is about, I guess, whether, if I interpret it correctly, whether the effect of COVID lockdown was different between the US and the Euro area, and if this affects your results. I think I know the answer, but I'll let you answer to this. But let me put it in a broader picture of Euro area versus US. So in the first part of the presentation, Lucrezia showed this different effect across the two economic area. And the model that was presented by Veronica shows a possible explanation for this, which is based on this different type of shock that affected the two areas, so by using the closed economy versus open economy model. But we can think that there are other differences, like you may think that wages are more rigid in the Euro area. The Euro area is less economically integrated than in the US. Clearly, you cannot put everything in the model, but I don't know if you want to comment something on this.
Yeah. So in the brief version of the model I show you, I think there are three ways in which the Euro area is different from the US. One is, as you say, well, actually two. One is that the terms of trade are different. But this shock we assume is the same, and this is maybe not the case. In reality, there may be differences in the size of the shock as well, because, for example, the commodity price shock may be more massive for the euro area, and maybe the supply chain disruption may be more effective for the US. So that's something that we don't have in the model, and of course, it would be interesting to explore. The other thing that we have is that I've shown you is that the persistency response of inflation is more sluggish if we have more price stickiness. We didn't have wage stickiness in the model, but wage stickiness we have wage stickiness in the paper. You can look at that, and that of course create also some more persistence. So that is definitely the case. And in terms of the COVID effects on lockdown, this is another example of supply uneven shock, because exactly like the lockdown were hitting some sectors differently from others, and this was generating different effects for the economy. Now, in that case, though, the inflationary effect at the moment of the lockdown, of course, were opposite, because there were like depression in demand also implied by the original supply shock, because people were losing their job, losing their income, and not spending anymore. And so there is an interaction between supply and demand that is important, more important during the lockdown than recently. And so that dominated the effect on prices at the beginning. I don't know if Lucrezia want to add anything.
Yeah, no, there are other things which are not in the model, but actually they don't break our story in a way. So we know that fiscal support has been more massive in the US than in the euro area, which may explain also why the US has been more resilient. Okay, so the trade-off between inflation and output is much more favorable in the US. Okay, but we don't study this particular mechanism. But this doesn't break our story. I mean, so that we are interested in in pointing out that good market transmission. Okay, so that the fact that this is an oil shock doesn't mean that has to vanish once the original shock retreats. Okay, so that's a very important point that explains some of the puzzles that everybody's struggling with. So that how come that we have this inflation even if labor market is so strong?
Plus, if I understand correctly, your VR estimates are mostly pro-COVID, so they're
pre-COVID. They're pre-COVID.
So
no, these are addressed for historical patterns, that are compatible with what we are seeing today. But of course, it's not. It's a big experiment.
So we have another question, and this is about, I think it's something that Veronica hinted, but maybe we could expand a little bit. So as you show in the report, inflation expectations seem to be under control. Maybe this is endogenous to the fact that there was this massive, policy response. So I don't know if you want to comment. So I think Veronica hinted this at the end, but if you want to say
of course, it's hard to say. I'm counterfactual of what the inflation expectation would be if we didn't, if monetary policy was less tight. But when we look back in history to episode with clear inflation, the anchoring of inflation, we have very big movement, and we have seen some movements, but very, very small. So sure, in part maybe endogenous, but our reading is that this doesn't give us a signal of a scenario where we were close to a spiral, uncontrolled spiral. I don't know if Lucrezia has...
Yeah, we interpret this as saying that central banks have enjoyed a credibility bonus. Okay, so that gives them a little bit more space to tolerate a temporary higher inflation to allow the relative price mechanism to work through.
We have another question about investment differences in the US, again, euro area, and how this relate to the different inflation paths. I don't know if the model can say something about this? Or if you can
investment difference between the US and the Euro can be reconciled with the same difference in terms of trade that I have mentioned for consumption more explicitly, because we don't have investment in the model. But the story is the same. If we have a shock that increase a lot international price of oil and the euro area import a lot of that, is like a bad income shock, and lower income means lower private consumption, but also lower investment. So I think that's the more reasonable big reason why there is this big difference. Now, of course, there are also other differences. Fiscal policy, we have already mentioned, is different between the euro area. It's more supportive of demand in the US, so that also may be part of the story outside of our model. But these are the two things that I think are important for investment.
So there is a question now coming in, which I think it's very much in line with your thinking, if I understand your thinking correctly. So basically, it says, to anchor expectation and show credibility, there is this quick reaction of monetary authority, but and the alternatives are more gradual tightening and have inflation higher for longer. So it seems to me that this is the view in your report. So what I like of your report, it kind of provides an alternative view to the, as Lucrezia said at the beginning, there were these two views, and you kind of provide an alternative view, which is consistent with the fact that inflation is persistent, but will still justify being patient, as you put in the title.
Yeah, I mean, I think that, yes, I like the question. I mean, what our report advocates is more tolerance and more patience for a higher inflation for longer. I mean, of course, this is very important to be clear about the fact of where you want to end up, okay? But, after all, the strategies of the central banks have been revised recently, and, to provide that kind of flexibility that now seems, the central banks may seem to go back to the idea of a flexible inflation target. It's I think there is too much penitence, too much, I think that actually they have the framework for being patient, which is provided by the flexibility of the recent revision of the strategies at both the Fed and the ECB. And it seems that this is the occasion in which to use that flexibility. So, and in fact, in history, I mean, I think that has always been the prevailing wisdom. Even Volcker didn't go for a killing. He just, he did it very, very gradually. And so I think that, I mean, this is our view. Okay, so. It doesn't seem to be the same view as Jay Powell and Christine Lagarde.
So we have, I can see the list of people who are in the audience, and there are many current and past central bankers. So I was surprised that nobody was reacting to this. So now we have a question. I don't know if I can mention the people. I don't know if they're publicly seen, but we have somebody who says, well, I think Veronica already answered, but let me repeat the question. What would have happened if the Fed and the ECB and not raised the interest rate by 500 basis points? $1
million question. I mean, yeah. So, I mean, we are not advocate for, the ECB and the Fed should have been at zero, not done anything. We are just saying that maybe they could have been a little bit more gradual, and nothing catastrophic would have happened, and maybe some recessionary effect, especially in the euro area, would have been milder. Of course, I mean, again, it's hard to say, but we are just saying that there has been a lot of discussion and lots of scare and lots of panic about this high level of inflation, and we're not just spread a word of caution that we were not so worried about that. And ex post, I guess, I don't know if it's in part is policy, in part is the shock, but it looks like inflation went down more than what people would have expected, or at least faster than what people would have expected, even with this monetary policy in place. So maybe there is something into our story after all.
I see no question coming in. So I have another question for you while we wait if some other question come in. So we discussed a little bit about comparing the euro area with the US, and but you also mentioned another potential comparison, which would be now versus then. So, you know, with the last time that we had high inflation was in the 80s. So what can you say about this? What does your report say about this?
Well, we spent some time analyzing, you know, the comparison with the Volcker era, and the difference is the credibility bonus that was clearly lost by the time that Volcker became chairman of the Federal Reserve. And you can see that on the expectation data. And in fact, we have an analysis of that. We try to decompose the dynamic of inflation in a component which is anchored, so around the target, and a component which is backward looking. And we can see that this component, which is backward looking, is much more important at the beginning of the 80s. So that's the main difference. The other difference, you know, is the labor market and the catch up between wages and inflation. In fact, if you look at the literature at the time, that was really the focus. And here, because economists are always very much, you know, history dependent in their analysis, everybody, you know, focus on the wage and inflation, the anchoring story, but we haven't seen it. And so I think that this is actually what the focus of analysis should be on, you know, of these differences. Of course, there is a part that we don't have in the report, but I think it's very important, which is the role of fiscal policy. And, you know, so in here, I think that a lot of the difference between the euro area and the US are also explained, but, you know, as I said before, by the difference in fiscal policy in the two jurisdictions. And, you know, the US seems to have reached a soft landing, at least so far, so good. But while, you know, the number for the euro area are deteriorating very fast.
One of the comments says that it is not driven, I guess, by my interpretation of the comment of this comment, that this is not driven by excessively tight policy, but it's all of China. So it's driven by drop of Chinese import. Possible. You, Lucrezia, you probably know more than everybody about what's going on.
About what?
About output data today, since you're
output data today, yeah.
The nowcaster.
Yeah. I mean, I think there is not in. I mean, I think that the consensus that China doesn't. I mean, matters much less than people think. Also for Germany. Yeah.
I don't see any more questions. Oh, there is one. So there is a question about what does your model says about the weighting that policymakers should put in core versus headline?
Well, I mean, we have like a little regression in the report in which we shows that core inflation is a lagging indicator. So that this actually was, in my time at the ECB, that was the common wisdom, not to look at core inflation because it was a lagging indicator, but actually it's the Fed that has put much more focus on core inflation. But, you know, you have seen those impulse response functions. Clearly, core inflation, at least in response to, you know, this kind of shocks, it acts with a delay, and the mechanism is really through the input-output mechanism. Okay, so the sector which is the oil consumer gets it first, and then you know, with a lag is the service sectors which does not use oil directly but use it only indirectly, and this you know, propagates you know, slowly. And this, so service, the component of service in inflation is persistent and lagging, and you know, so that so persistence is important for a central bank. But I mean, in terms of trying to anticipate what's going to happen to inflation, I mean, not core is not a leading indicator.
So there is a clarification question. When you say being more gradual, are you thinking by raising less or raising the same amount at a slower pace?
well, starting slower and see what happens, I would say. And keep an eye on inflation expectations.
Yeah.
And maybe, I mean, of course, I mean, you know, we don't have the last word on everything, but I mean, I think that maybe more focus in central bank analytical work should be on understanding, you know, this relative price mechanism and efficiency, and trying to see when this, you know, this process of adjustment to relative prices has actually been absorbed. Okay, so that could be the basis for constructing indicators. Okay, to have an idea of these trade-offs. Okay, so on one hand the efficiency story, and on the other hand the expectation part.
Yeah, and for sure, also following up on the previous question, the model would say that you know, it's good to have some inflation in sectors that are using more directly oil or energy, because that is going to allow for the reallocation of resources towards the sector that use it less, and so they're cheaper and more efficient to produce. So maybe that's something that also the central bank should look more at the heterogeneity of the sectors, looking at oil intensity and how, I mean, different input-output structure.
Since we have a couple of minutes and I see no question, I'm going to ask you a question to Veronica, which is outside the report, but I'm sure you thought about this. So about the time in which you were finalizing the report, two of your co-authors of the paper you mentioned before, Guido Lorenzoni, Ivan Vernick, wrote a paper, I think it came out about the time, showing that inflation can arise from a non-monetary modeling, which is purely, if I understand the paper correctly, is a pure conflict issue. Does this, would you write your model differently on the basis of this paper? Would you? First of all, to interpret the paper correctly, because you probably you know it better than me, I'm sure.
I don't think so, in the sense that they for sure provide a complementary explanation for the inflation, and I think that it's interesting to look at that as well. But I think our main mechanism, given again the importance of the goods market in this particular episode, I think it's relevant per se. And then the story, of course, of the world is more complicated, and we can put all the pieces together. But I wouldn't write that differently. Actually, okay. We wrote this after anyway, so.
Okay. So you know the timing better than me. Okay, I don't know if we have 1 or 2 minutes, if there is any more questions. I don't see any more questions coming, so let me just thank Lucrezia and Veronica for #1 writing the report, and for presenting it in Geneva, and then I'm sure you'll present it in many other places, and for doing this. And I with my hat of ICMB, I'm very happy that I asked you guys to write this thing, because I think our objective is to put new and provocative ideas. So I think this is fantastic.
Thank you very much, Ugo.
Thank you so much.
Thank you.
Thank you, everybody. Thanks.
Bye, Lucrezia. Bye, Veronica.
Bye-bye.
Thanks, everybody, for being here. Bye.
Bye.
Bye-bye.